Picture this. You wake up on a Tuesday morning, pour yourself a cup of coffee, sit down at your kitchen table, and you open your laptop. You go to the Social Security Administration website. You fill out a few forms. You click Submit. And just like that, you have just locked in a decision that will affect every single paycheck you receive for the rest of your life. No going back, no do-overs, no second chances. Now here's the scary part. Most people over 60 make this decision completely wrong. Not because they're not smart, not because they don't care, but because nobody ever sat them down and explained the real rules of the game. And the Social Security Administration, they're not exactly going out of their way to make sure you maximize your benefit. That's exactly why we're here today. My name is Max, and if you are 60 years old or older, what I'm about to share with you in this video could literally be worth tens of thousands of dollars, in some cases over $100,000 over the course of your retirement. So do not click away. Grab that coffee, sit down, because this is the most important financial conversation you are going to have this year. Why most people get Social Security completely wrong. Let me ask you something. When you think about Social Security, what's the first age that comes to mind? Most people say 62, and that's the problem. See, the Social Security system was designed with multiple claiming ages, and each one of those ages comes with a drastically different monthly benefit. But the way the system is marketed, the way people talk about it at the dinner table, the way your neighbor down the street talks about it, everyone just defaults to, I'll take it as soon as I can. And as soon as I can means 62. Here's what that decision actually cost you. If your full retirement age, what the SSA calls your FRA, is 67, and you claim at 62 instead, you are permanently reducing your monthly benefit by up to 30%. Not temporarily, not for a few years, permanently, for life. Every single month, for every year you live past that point, you are getting 30% less than you could have gotten. Now I know what you're thinking. Max, I'd rather get the money now while I'm still healthy. What if I don't live that long? And that is a completely valid thought. We're going to address that in detail in just a moment. But first, I need you to understand exactly how this system works, because most people, and I mean the vast majority of Americans, have never had it explained to them clearly. So let's fix that right now. How Social Security actually works. The basics you must know. Social Security retirement benefits are calculated based on your 35 highest earning years. The SSA takes your earnings from those years, adjusts them for inflation, and uses a formula to come up with what's called your AIME, your average indexed monthly earnings. From there, they apply another formula to give you your PIA, your primary insurance amount. That PIA is the benefit you receive if you claim at exactly your full retirement age. Now, your full retirement age depends on when you were born. If you were born between 1943 and 1954, your FRA is 66. If you were born in 1955, it's 66 and 2 months. It keeps going up by 2 months for each birth year after that, until you hit 1960 or later, and for anyone born in 1960 or after, the FRA is 67. So if you're 60 right now, in 2025, your full retirement age is 67. That's the baseline. That's the number we're working from. Here's where it gets really interesting and really important. You have choices. You can claim early at 62. You can claim at your FRA at 67. Or you can delay past your FRA all the way up to age 70. And here's the kicker. For every single year you delay past your FRA, your benefit grows by 8%. That's guaranteed. That's not a stock market return. That's not a risky investment. That is a government-backed, guaranteed 8% annual increase. Show me any investment in today's market that gives you a guaranteed 8% return, and I'll show you something that doesn't exist. The break-even analysis. When does waiting actually pay off? Now let's talk about the break-even point. because this is the number that determines whether waiting makes financial sense for you specifically. Let's use a simple example. Say your benefit at FRA at age 67 would be $2,000 per month. If you claim at 62, you're taking a 30% cut, which brings you down to $1,400 per month. If you wait until 70, you're adding 24% on top of your FRA benefit. So instead of $2,000, you're getting $2,480 per month. Now here's the math. If you claim at 62 versus waiting until 67, you're getting $600 more per month by waiting. But you gave up 5 years of payments. 5 years at $1,400 a month is $84,000 that you didn't collect. So to make back that $84,000 at $600 per month more, you need about 140 months, roughly 11 to 12 years. That means you break even around age 78 to 79. If you live past 79, which statistically speaking many Americans do, waiting was the right call financially. The average American man reaching age 65 today is expected to live to about 84. The average woman to about 87. That means for most people, waiting past 62 and even past 67 can make a tremendous difference in lifetime benefits. But here's the thing, and this is crucial. This isn't just about math. It's about your personal situation, and that's what Max is here to break down for you today. The 5 factors that should determine when you claim. There is no single right answer for everyone. The decision of when to claim Social Security is one of the most personal financial decisions you will ever make. But there are 5 key factors that should drive that decision, and if you walk through each one honestly, you will have your answer. Factor 1. Your health and family history. This is the big one. If you have serious health issues, if your family history suggests you may not live into your 80s, then claiming earlier might make more sense. You need to collect benefits long enough to justify waiting. On the other hand, if you're in great health, you exercise regularly, your parents lived into their late 80s, statistically you have a longer runway, and delaying your claim could mean significantly more money over your lifetime. Factor 2. Your current financial situation. Do you need the money right now? If you're 62 and you've lost your job, you have no other income, and you're struggling to pay your bills, then taking Social Security early might be a necessity. There's no shame in that. Social Security was designed to be a safety net. But if you have other income, a pension, retirement savings, a part-time job, if you can afford to wait, then every month you delay is money in your pocket down the road. Factor 3. Whether you're still working. This is something most people don't think about. If you claim Social Security before your full retirement age and you're still working, the SSA will actually reduce your benefits temporarily. In 2025, if you're under FRA and earn more than $22,320 per year, the SSA withholds $1 in benefits for every $2 you earn above that threshold. Now, they do give that money back to you later. They recalculate your benefit when you reach FRA, but it complicates things. The simple rule: if you're still working and earning a decent income, don't claim early. Factor 4. Your spousal strategy. If you're married, your Social Security decision is not just about you. It affects your spouse too. The higher-earning spouse delaying until 70 can be one of the most powerful financial moves a married couple makes, because when one spouse dies, the surviving spouse gets to keep the higher of the 2 benefits. So if the higher earner claimed at 62 and took a 30% cut, that reduced benefit follows the surviving spouse for the rest of their life. That could be your wife or your husband living on a significantly reduced income for 20 or 25 years. On the other hand, if you're the lower earning spouse, it might make more sense for you to claim earlier, while your higher earning partner waits. This way, you have some income coming in while the bigger benefit continues to grow. Coordination is everything when it comes to spousal Social Security strategy. Factor 5. Your other retirement income sources. Think about your complete financial picture. Do you have a 401k or an IRA? Do you have a pension? Rental income? The more other income you have available, the more flexibility you have to delay Social Security and let it grow. In fact, many financial planners recommend a strategy where you draw down your retirement accounts in your 60s before age 70, specifically to allow your Social Security benefit to reach its maximum. It's called a spend-down strategy, and for the right person, it can be incredibly effective. The specific rules for claiming at 60. What you need to know right now. Now, let's address the people watching who are right at 60. You can't claim yet. The earliest claiming age is 62. But you are in the most critical window of your entire Social Security journey. What you do in the next 2 years will shape your benefit for decades. First things first, go to ssa.gov and create your My Social Security account if you haven't already. This is free, this is easy, and this will show you your estimated benefit at 62, at your FRA, and at 70. You need to see these numbers. You need to understand exactly what's on the table before you make any decisions. Second, check your earnings record for errors. This is something people almost never do, and it is a massive mistake. The SSA calculates your benefit based on your reported earnings, and sometimes those records have mistakes. Jobs you worked where your employer didn't report correctly, years where your earnings look lower than they actually were. These errors reduce your benefit, and unless you catch them and report them, the SSA will never fix them. Log into your account, pull up your earnings history, and go through it year by year. If something looks wrong, contact the SSA immediately. Third, if you've had years where you earned nothing or earned very little, maybe you took time off to raise children or you had a gap in employment, consider whether working for the next few years might boost your benefit. Remember, Social Security is calculated on your 35 highest earning years. If you have some 0 years in there, replacing them with working years, even part-time work, can meaningfully increase your monthly benefit. The Social Security strategies the government won't tell you about. There are advanced strategies that financial planners charge thousands of dollars to explain. Today, Max is going to give them to you for free. The Restricted Application Strategy for those born before 1954. If you were born before January 2nd, 1954, and some viewers watching this absolutely were, you may still be eligible for a strategy called the Restricted Application. This allows you to claim only spousal benefits at FRA while letting your own benefit continue to grow. This strategy was largely eliminated in 2016, but there are specific people who can still use it, and if that includes you, it could be worth significant money. The Voluntary Suspension Strategy. Let's say you claimed Social Security early and now you regret it. You're getting less than you could have gotten. Is there anything you can do? Actually, yes, potentially. If you're between your FRA and age 70, you can voluntarily suspend your benefit. During the suspension period, you stop receiving payments, but your benefit earns delayed retirement credits, that same 8% per year. Then, at 70, or whenever you resume, your monthly check will be higher. This isn't right for everyone, but for the right person who claimed early and has other income to live on, it can partially undo the damage of an early claim. The Social Security do-over. Here's one that almost nobody knows about. If you claimed Social Security within the last 12 months and you wish you hadn't, you can actually withdraw your application. You file a form, SSA 521, and you pay back every dollar you received. Then it's as if you never claimed. Your benefit resets. You can claim again later at a higher amount. This is only allowed once in your lifetime, and you must do it within 12 months of your original claim. But for someone who made a hasty decision and quickly realized their mistake, this is a genuine lifeline. Social Security and taxes. The hidden cost. Most people miss. Here's something that surprises a lot of people. Social Security benefits can be taxable. Yes, you read that right. Depending on your combined income, which the IRS calculates as your adjusted gross income plus any non-taxable interest plus half of your Social Security benefits, up to 85% of your Social Security benefit can be subject to federal income tax. If your combined income is between $25,000 and $34,000 as a single filer, up to 50% of your benefit may be taxable. Above $34,000, up to 85% is taxable. For married couples filing jointly, those thresholds are $32,000 to $44,000 for 50% and above $44,000 for 85%. Why does this matter for when you claim? Because if you're also drawing from a traditional IRA or 401k at the same time as collecting Social Security, you might be pushing yourself into a higher tax bracket. This is another reason why some financial planners recommend drawing down your retirement accounts before claiming Social Security to potentially reduce your tax burden in the years when your Social Security benefit is active. What happens if you keep working after 62? One of the most common questions is, can I collect Social Security and still work? And the answer is yes, but with some important nuances. Before your full retirement age, as we discussed, your benefit is reduced if you earn above the annual limit. But here's what most people don't know. Once you reach your full retirement age, there is no earnings limit whatsoever. You can work full-time, earn six figures, and your Social Security benefit is not reduced at all. In fact, if those working years are among your highest earning years, the SSA will automatically recalculate your benefit upward. After your FRA, continuing to work and delay claiming is almost always a winning move. You're earning income, your benefit keeps growing at 8% per year until 70, and you're continuing to potentially replace lower earning years in your 35-year calculation. Triple win. The emotional side of this decision. Look, we've talked a lot of numbers today, a lot of percentages and thresholds and strategies. But I want to take a moment to acknowledge something that doesn't get talked about enough in the financial world: the emotional weight of this decision. For most people, Social Security is not just a financial asset, it's peace of mind. It's the knowledge that no matter what happens to your investments, no matter what the stock market does, no matter what the economy looks like, there is a check coming every single month. That security has real value. And for some people, that peace of mind is worth claiming a little earlier, even if the math says to wait. That is a legitimate reason. You are allowed to factor in your own happiness, your own mental health, your own sense of security when making this choice. Financial planning is not just about maximizing dollars, it's about maximizing your life. What I want for you, what Max is fighting for every single time we sit down together on this channel, is for you to make this decision with your eyes wide open. Not because your neighbor did it, not because you heard something at a family barbecue, but because you understood your options, you ran your numbers, you thought about your life, and you made the choice that's right for you. Your action plan. Starting today, let's bring it all home. Here's your step-by-step action plan if you are 60 or older right now. Step 1. Go to ssa.gov and create or log into your My Social Security account this week. Not someday. This week. Look at your estimated benefits at 62, 67, and 70. Write those numbers down. Step 2. Review your earnings history on that same account. Check every year. Look for errors. If you find any, contact the SSA and get them corrected before you claim. Step 3. Think honestly about your health, your finances, your spouse, and your other income sources. Go through those 5 factors we talked about and see where you land. Step 4. If you are married, sit down with your spouse and have a real conversation about Social Security coordination. The difference between a good spousal strategy and a bad one can be enormous. Step 5. Consider speaking with a fee-only financial advisor who specializes in Social Security planning. Not someone who earns commissions, not someone with products to sell, but someone whose only job is to help you maximize your benefit. Even one session could be worth thousands of dollars in lifetime income. And step 6, keep learning. Subscribe to this channel. Come back. Because Social Security rules change, tax laws change, and the more you know, the better equipped you are to protect your financial future.